CTM. What's going on, everyone? I hope you are well and doing great on this Wednesday, on this FOMC Wednesday. And it is a rather big deal. I know that as we've undergone this rate hiking cycle, it seems like each and every FOMC meeting really is the most important. And that's because it has. Obviously, it wasn't like that. It wasn't like that if you go back into 2020, 2021. There was a period of time when the Fed had rates down to zero, and we were looking at quantitative easing taking place, and there were no signs of that ceasing or coming to an end. And at that point, not only did the Fed not matter, but also these data, high impact data events that we look at, like CPI, like the jobs markets, at that point in time, they didn't matter. And if you remember, prior to Jay Powell going all sorts of, I'm flooding the system with money, $4.1 trillion expansion of the balance sheet. Prior to then, we looked at news events because it mattered. Once that happened, I said, these no longer matter. They've become irrelevant for now. And then when they started mattering again, we brought it back into the picture. I was also watching this morning a video that I put out, Jay Powell, and the FOMC. This is going back into March of 2021. And in that video, I was talking about how the greatest risk to the bull market was indeed going to be Jerome Powell, and the Federal Reserve and their monetary policy. Sure enough, that's exactly what happened. We saw in November 2021 where Bitcoin topped and the Fed began tapering down its quantitative easing purchases. So why it's very difficult 3 years out. This was 2019, right? What's the date on this video over here? November 2019, making some type of predictions that are going to happen years out, especially when you're talking about you have these central banksters, these central planners in this central bank system that go ahead and dictate policy. Not bad. Yeah. I know. People like 6-figure predictions and things like that. We've moved on. I mean, look, you don't get much better. You don't get the timing. You don't get much better than that. But what that has become to us is basically irrelevant, as we know what side of the market to be on, when to be on the market, and on what side. And that right there, my friends, is priceless. Nevertheless, we want to be the best. Whether you're talking about discretionary TA, whether you're talking about the macro, we work hard each and every day to make sure that we get it and get in front of it. We got a big session ahead of us as today is FOMC day. We're looking at the equity markets here right now are green. The dollar selling off. Continuing yesterday, we saw the dollar green on Friday, or what day? On Monday. And then yesterday, early in New York, give up that green, turn red. And now we're seeing an extension of that. Yesterday, the 10-year yields were quite green, up 3 and 4%. Today, they're feeling the pain. And oil continues extending its downward momentum because oil seems to be looking. By the way, do you know that the U.S. is still draining the strategic reserve? They are still draining it. And you know what? I have to say, if we do continue to see deflationary pressures continue to be paramount, if we continue to see a slowdown, a global recession, and lack of demand, and oil come down 55, I mean, lower than that, 35, at that point in time, the U.S. is going to look pretty smart about the time that they drained and the time they refilled that. But that's not a given. We have to follow the technicals. We could see lots of things happen. One of the things that we could see happen would be actually oil, even though it's undergoing a breakdown right now. I don't like this chart as much as my log scale, but just to make the point, you could see the breakdown of the trend line that I'm highlighting. You could also see, without me pointing it out, once you had the breakdown, price then came back up, retested that broken trend line that was support. It became resistance. And now we are resuming down further, right? Whoops, sorry about that, Yamato. I didn't mean to do that. And highlight that comment. Will we look to have an oil John, I'm gonna go ahead and favorite this comment so that we could come back into it. Today's FOMC day. I want to make sure that we start this off, including Bitcoin. I'll come back to Bitcoin and we will look at the technicals. We'll make sure that we are ahead of what could potentially be happening today. But I want to start off with laying out what we're looking at today, because Jay Powell is getting ready to take the mic today. He takes the mic at 2:30. The rate statement is at 2 o'clock. At 2 o'clock, we will find out whether or not the Fed meets market expectations of a 25 basis point hike or surprises the market moving towards a pause. Now, likely the Fed is going to hike 25 basis points, even if they don't want to, even if they understand what could potentially be a dire situation for banks inside the United States. If they were not to hike 25 basis points today, a lot of people would be asking a lot of questions, and likely there would be turmoil, and likely there would be a bloodbath of red in the markets today if the Fed does not go ahead and raise rates 25 basis points. it could happen. I would attribute it a very low possibility. It's also a possibility today that Jerome, I think I put out this tweet just a little bit earlier, and I said, look, it's not a matter of what you think that Powell and the Fed should do, but what they do indeed do. The greatest risk right now is how the markets are currently priced is for June to remain. Greatest risk right now to the markets is that June becomes a live meeting. Right now, the markets are pricing in. This is the last hike of the cycle, of the rate hiking cycle. Now, we saw yesterday, we did see, because this is May. I mean, everyone knows that we have 25 basis points priced in, but you move to June. By the way, yesterday, June's meeting was pricing out 0% chance of a 25 basis point hike. Just 2 days ago, it was pricing in a 35 basis point hike. We're pricing in a 12% cut now, but really the general consensus is that we pause. This is the last hike of the cycle, and that June meeting will be a pause. If Powell is very clear that that is not the case, we will see this reprice drastically by the end of the day. That is, I believe, the greatest risk for the market. Now, likely, Powell, this could be the one and done. Fed moves to a pause. It's a major event during the tightening cycle. So we want to look closely at that today. We want to see if we're going to, that's going to lead to some type of melt up in the risk markets, or this time will be a little bit different of what we've experienced recently. And this might become a sell the last rate hike event. We'll look at it all. We'll put it together and we'll do our best to stay on the right side. This is a pretty big deal today. We're seeing, and you're probably aware of, the U.S. Treasury is looking to design a program that they're calling buyback government debt, which plans to begin executing next year in 2024. That's going to align really nicely with the Bitcoin halving. Now, whether or not you believe in the Bitcoin halving, whether or not you believe that it is likely monetary policy and easing and tightening cycles, or whatever the case may be, there is a psychological aspect, and there is going to be front running of the Bitcoin halving. And we're going to have conversations just as we had in 2020. People were adamant that the halving is priced in. Jordan, this is all nonsense because the halving is priced in. Okay, it wasn't, but we'll have those same conversations again. And likely, as we were going to see the Fed at some point, whether or not it's this year, as the markets are pricing in this year, we're going to see rate cuts. You can see already in June, the market is beginning to price it in. Let's look at July, right? July, a much greater chance that right now the market is thinking the Fed will be cutting. And then we move until September, and there's almost a 50% chance right now that the markets will be cutting. Move to the end of the year, and it looks like the markets are pricing in. We will have had 3 cuts by the end of the year. Now, this is subject to change. If you looked at this just maybe, the beginning of March, this looked drastically different, and the markets were pricing in like peak tightening. At this point in time, it looks like the markets have overshot, as these things tend to do, and is now pricing in peak easing. However, with good reason, perhaps. The Fed might be forced to follow the market. By the way, Fed's dot projections today, dot plot projections, I believe are going to be very adamant. They're going to try to let the market know that they intend to be holding rates higher for longer. Now, whether or not that happens or they can do it, that's a whole different conversation, and nobody has a crystal ball and nobody knows. But I don't think that the Fed is going to go ahead and fold. That would be a surprise if they started showing cuts by the end of the year. That might signal that indeed we are looking to be in a more dire situation and position that the officials have led on. We were told that the banking crisis is over and that it's sustained. Whether or not that is the case, well, we're soon going to find out. So let's keep moving. Let's keep look. This is a big deal, by the way. This sounds to me like yield control curve. And when I hear liquidity support purposes, they say that they're doing it right? That the reason that the Treasury is looking to do that is for liquidity support purposes. That doesn't sound good to me. It doesn't sound good that the largest market in the world, the US Treasury market, it might be having potentially some type of liquidity problems. Gold, the last time they did this was 2020. Gold loved it. Let's look at 2020. Let's look at the gold market, and you could see, jump back and over here. This is when you saw gold begin its 12-year bull market ascent. So the last time it happened, gold loved it. I don't think gold is probably going to continue to do well. And by the way, if we zoom in a little bit, you could see ahead of the FOMC. Today's a game changer. We're going to see, obviously, volatility. And I can't tell you whether or not, whether it's gold, whether it's Bitcoin, whether it's the stock market, whether it's yields and the dollar, whether or not ahead of time they're going to go up and or down. But I could give you very clear and concise levels on each of what to expect if X happens, Y expectations. And that right there is what trading is all about, and that is everything. A lot of people like to talk about projections. A lot of people like to talk about possibilities. A lot of people like to be very, quote unquote, confident in what they believe is going to happen. But watching and trading what is happening, that is why you are here. That is what we do the best, and that is what you are looking to learn. Thanks for that. Remove that timer over there, Manuel. I appreciate that. Getting that off. 0.00. Hope is not a price prediction. All right, let's keep going. So looking at gold today, though, this is looking at the monthly chart, and you can see it looks like it's taking another run at what is the lip of the cup and handle. If it is able to break out over here, a lot is shaping up to set gold off into after consolidating here for 12 years. We looked at that 12-year run up, and then we were seeing gold consolidate here for another 12 years. A lot is pointing to potentially a breakout. And if that happens, we could be looking at through the rest of the decade as monetary reset happens, as central banks are out there picking up the shiny stuff, as the BRICS are potentially getting ready to back a currency, buy gold as well. We know that the central bank digital currencies are getting ready to be launched. IMF clearly behind that, part of the special drawing rights that they wish to back the new reserve currency, not the dollar, but they're looking to make it the IMF special drawing rights. Part of that also has a gold allocation, a lot. And then the biggest signal of all is that further debasement of the US dollar, all pointing potentially to larger gold prices. You could see silver over here on the right of the chart after that trend line breakout over here has broken out and hasn't even come in for a full retest, has been consolidating with some strength and holding, looking to see if it gets ready for its next move up. And then here's a look at gold on the weekly. So you can see the top of that lip. Gold needs to close above here. Let's call it $2,080 and then maintain that for a breakout to ensue. But it is coming into resistance, and resistance is resistance until broken. Again, nobody knows whether or not you're going to get the breakout now. A lot of people are hoping that now is not the time. A lot of people are hoping that potentially we see some type of reprieve. I know I want to talk about the Treasury, and I know I want to talk about yield control, and I know I want to talk about how my expectation is how Bitcoin reacts to that. We did look at just a second ago of how gold reacted to the last time the US Treasury began their buyback program. But what we're looking at over here right now is currently the debt ceiling, right? What did I wrote? Yeah, the debt ceiling. Got to spell ceiling right over here. Crisis of 2011. Does that give us any clues? Right now, we are on the clock. We got a standstill right now between lawmakers and going ahead and doing the inevitable, and that is stopping a U.S. default and just going ahead. There's really no ceiling. We all know it's a Ponzi. It's a debt-based system, so that they have to keep raising it. But right now, politicians are being politicians, and they're playing the game, and that's all it is one big game. We all know that they're on the same side. I remember when I learned that. It wasn't, into 2008. And it was when President George Bush Jr. was the president of the United States, and he had just lost the election to Barack Obama. And Barack Obama came to the White House to meet with George, and they had a nice conversation, and they walk out of the courtyard of the White House, and George, in front of all the cameras, says, you know, my good friend Barack just asked me if I would give and let the banksters have the next half of the $350 billion bailout. You think the first time that these two meet after being elected president of the United States, the first thing on his mind is to go ask the sitting president of the United States to release another $350 billion to the banksters? They're on the same side, and it's not working for us. They work for the powers that be, right? And that's just the way it is. We are looking at potentially getting towards a resolution as the clock is ticking. And right now, U.S. Treasury Secretary Janet Yellen told us that potentially by the 1st of June, the Treasury could run out of money. You guys need to do something. Now, likely it's not June 1st, and likely she's just trying to, get people moving. It is possible the bond market beginning into price of default. It is possible that mistakes are made. You never know what is going to happen, but let's assume it gets resolved. What happened the last time the debt ceiling was resolved? By the way, Stanley Druckenmiller, he's warning that there's bigger problems beyond the debt ceiling battles. He's worried about the bigger picture, and that's the U.S. debt crisis. That's signal right there. Let's go ahead and look at what happened. The last time that occurred was, let's jump over to Investopedia, and they're going to show us it was on August the 2nd, right? So I'm just jumping down over here, and I'm looking, and I'm finding sometimes when I do this stuff with you live, I can't find out where it is. So let me try this. There we go. Congress resolved the debt ceiling on August the 2nd. Let's take, with that in mind, a look at what was going on. I'm going to move over to 2011, the summer of 2011. I remember I was over in Bosnia-Herzegovina, and people no longer would accept U.S. dollars. They thought that the U.S. dollar was done. 10 years later, 11 years later, no, the U.S. dollar is still the reserve currency. A lot of people today thinking that the dollar is done. It's going to take a while, but you all know that. I don't need to get into that now. Here's the date. You ready? I'm coming over here. This is the pressure of the S&P 500. We're looking at the S&P 500 coming into the resolution of the debt ceiling. Debt ceiling was resolved on August the 2nd. Upon it being resolved, and what was it, $2 trillion they added? I don't know if it was $1 or $2 trillion. They had 1.4. They like that number, 1.4. What was the number? $2.4 trillion, right? First, they increased it 1.2 trillion, and then another 1.5 trillion was subject to Congress approving that later on. The reaction of not only the S&P 500, which you could see upon the resolution sold off really hard. Bitcoin also, you could see that upon the resolution sold off really hard. What did the dollar do? Well, before we look at the dollar, what did gold do? Gold, once it sold off in 2011, here we go. Where's the top? As soon as the debt ceiling was resolved, gold topped. Gold actually topped its bull market. Are they connected? I don't know. But what else happened over here? It was the dollar. What happened once the debt ceiling was extended further? Well, the dollar, which was under pressure coming into it, right? And I'm trying to think, versus the euro at that particular point in time, I think we were looking at $1.47. I want to check that out with you in 1 second. But we did see the dollar then base out for another month or so, and then began actually appreciating in value. And I'm just trying to say, Bitcoin, this is when it already had corrected hard before the dollar even was able to begin its run. One more thing I want to check out with you all, and that is going to be what the euro US dollar was doing. So before that, let me come back over here. Let me just get over to there. I'm on the debt ceiling. It doesn't matter over there. Let me take a look at Forex. Let me jump over and look at the euro US dollar. And let's see in 2011, during August the 2nd, when that was resolved, what we saw happening over here. Here as we go, you can see it was $1.47. And then we look at June, right? July to August 2nd, right over here. This was it topped right before the resolution. Upon the resolution, you saw obviously the US dollar begin strengthening. So we're at a similar situation in so much as that right now, people believe that the US dollar is toast, and rightfully so. The US dollar is under pressure right now as lawmakers play games. And we could see that the US dollar tried to again break out. Now, this isn't our best work over here. This trend line over here is correct, but we also had above here a yellow line, and we want to close above both in order to have a buy impulse take effect. We didn't even close above. We just peaked above the yellow one over here. Again, I have a better view of this. We'll be looking at it later in the session, but this is just what I have in front of me. You can see the dollar thus far has been rejected. You could see, or I can just make a little trend line over here connecting the recent lows. If we break down below that, likely we're taking out the February low, and we could see a test of the whole number. When I say the whole number, I'm talking about 100 on the DXY. You can see this is resistance, resistance. It was flipped to support. Extend that out, and you're going to see that area over here will be the next leg down. That's likely where we come into play. If that doesn't hold, we're going lower. Next bit of support is down much further, and we could even be, before this is resolved, trading much lower. But what happens when it is resolved? At that point in time, will we then see the dollar gain its legs? Will we then see this move on gold, this potential breakout on gold, be put to an end? I don't know. I mean, that is what happened last time. We did see immediately, though, Bitcoin and S&P 500 equities under pressure. It's something to be aware of. My expectations are that we could continue to see a little bit of headwinds against equity markets until the debt ceiling is resolved. But looking back at what happened last time, it was after it was resolved that actually we saw a lot of pressure. So we're just going to keep that in mind. We're looking at the US Treasury, and they're saying in 2024 is when they begin this buyback problem. I happen to think this is when Bitcoin is going to shine, and it could have its grand awakening as yield control curve is underway. If you've been following the relationship that we have been pointing out here between yields and Bitcoin in this high inflationary environment, you understand why. If yields are capped because of the Treasury being on the bid and monetizing the debt, Bitcoin might really have its grand awakening, and it might resemble something like gold did over here. So whether or not you want to call that a little bit of bullish hopium or whatever have you, I don't know. Yamato, we have a lot of help. Someone in CTM really has offered to go ahead and take you under their wing and really help you, get you off the 1 minute time frame to really help get you grounded. I wonder at this particular point in time why you are fooling around with any type of discretionary trading and not over here just simply making sure that you have the soundness of CTM 2.0 to keep you on the right side. Because right now, if you've been trading in the market for the last week or two, you have to ask yourself why. We're neutral, we're on the sidelines, and we're waiting and ahead of the Fed. And that's a massive position in power. Nobody knows, by the way, on Ethereum here, I can see a diamond, right? You see that diamond pattern, right? Which means that this thing could either break down or up, and nobody knows. I don't know. You don't know. Being neutral is a really good place to be ahead of the FOMC. Now, as it's been for the past year, and I'm not going to, give this an absolute, but more often than not, way more often than not, coming into the FOMC, we've been holding an open position into profit. This is the first time that we're neutral since I could remember. And I think we're right about that. And we're a lot closer. Cardano is very close to triggering a short trade. Let's take a look at that. Let's start with Cardano. And Cardano, a lot of people were looking at, by the way, inverse head and shoulders that was forming, right? And we saw the breakout of that, and then we saw the breakdown of that. And now it looks like you could also be looking at a head and shoulders. That's a left shoulder. That's a head, and that's a right shoulder. The neckline is going to be almost horizontal, right where it is right there. And we're getting very close to a breakdown over there. The measured mood of that breakdown, you take the distance from the neckline to the top of the head, and then you go ahead and you put it the other way. It's taking us right down to this March low. If price breaks down over here, CTM 2.0, 8-hour time frame, will be triggering short and be triggering short right away. Become the casino. This is the casino. This is the casino. The casino has the edge. This is the edge. Now you can look at Ethereum as well, and why I don't know what happens next. You could see that Ethereum is a lot closer to triggering on the long side than on the short side. I'm going to go ahead. You see this orange reddish deviation up over here. It's got quite a bit of a distance. It's got $326 over here before it would be negative. So we are quite bullish over here, and rightfully so. Price is going upwards. We are very close. If price were to break this trend line I'm drawing over here right now, we are very close, about $67 away from price triggering a buy. So we're a lot closer here in this upward momentum structure right now to be back on the long side than we are on the short. Not on Cardano. Cardano is very close here for triggering on the short side, right? And zoom out, and on Cardano, this looks nothing more like a really strong downtrend, which potentially is getting ready to roll over. Isn't that beautiful how that works? On Bitcoin as well, it's very similar. On Bitcoin, we're looking at being still very close. If you saw any upward, watch that line. If you saw an upward break of that line, Bitcoin is going to be long. It still needs to roll over and prove itself to the downside. And that all makes a lot of sense when you look at Bitcoin from a discretionary standpoint. Let's look at what's going on with Bitcoin right now. And Bitcoin, you can see this is the area that I'm first highlighting. The area that that doesn't work. First of all, you don't need any type of leverage, right? Yamato, I'm giving you some time here, but what I really want to do, I know Ace is absolutely like an honor to be working alongside him. But Ace wants you and anyone else willing to get to the top as well, right? So there are other people as well. Everyone thinks of you as a friend, and they want what's best for you. And that's the truth. And that's CTM strong right there, is we want to summit to the top of the mountain. We know what time we summit to the top, that we're going to be looking on the horizon, and there's going to be even a greater range. And we're going to go ahead and we're going to prepare ourselves, and we're going to do our best together to summit to the next highest peak that we could find. But we want to bring everyone with us. We want to do everything in our power. Leverage is a dangerous thing, right? You're looking here since 2020, and on Bitcoin, it's a pretty good performance, right? If you add some type of leverage to it, now you mentioned 10x, right? If you were to add 10x leverage to this, right? I don't even want to get into leverage, but let me show you what that were to look like over here. All right. So you could say, well, you see how close you were to busting and failing? The idea here is to compound over a lot of people. They overestimate what they could accomplish in 2 years, and they severely underestimate what they could accomplish in 10. I have shown you before compounding at a rate of something like 60, 70, even 30% of what you could do in 10 years. And I do believe that it has put everyone into a substantial financial position that they really have dreamed about when they got into the markets. What happens if I were to go back just a year further into 2000? By the way, that's when we began CTM 2.0. It's about 1 year ago, last March. And then you could see over here, like, you didn't bust yet. I'm trying to make us bust. I really am. So the drawdown needs to be a little bit higher. Let's come back to 2020. I'm not trying to get anyone here to give them the type of I feel like I might potentially, this is 3 years, give someone the ability here to maybe gamble and do things they shouldn't do. And I don't want to do that because it could end in bust. I'm going to go to 2017 over here, and I'm trying my hardest, fam, to get us to bust over here because you never know when it's going to happen. There you go. Finally busted it. And that was the whole point. Now, coming back over here, and if you were to use something like light leverage, I don't want to talk about leverage because leverage is not needed. This return over here, and I'm going to come since, 2020, right? I'll do after the big bull run, right? Because from January into February over here was a good move. You're looking at no leverage. You do not need any type of leverage. By the way, on Ethereum, those returns are significantly greater from the same area over there, 2020. This is no leverage whatsoever. The returns are significantly greater on Ethereum. Nevertheless, you never know what's going to happen in the future. Make sure you understand what proper portfolio allocation looks like. If you use something like 1.15 leverage during that same period on Bitcoin, you could see a pretty substantial improvement, right? And an acceptable drawdown. But we don't need no stinking leverage. Our edge, our system, our strategy is such that all that is needed is spot only. Even the buy side only is all that is needed. If you get yourself into a place where you stop gambling and you're not out there looking for what is the next, Pepe coin, and instead you're focused on approaching the markets in a mechanical, systematic way so that quarter over quarter, year over year, you're looking to go ahead and compound gains at really substantial rates. This is on Bitcoin. This is on Ethereum, and that's only 3 years, right? Go back further and it gets ridiculous. Come back to 2017, include that beautiful bull market. And yes, that you're looking at obviously still a low drawdown. By the way, notice our percent profitable. This is systematic. Anyway, what happens if you added light leverage to that? Let's go ahead and look at what 1.15. Now, people talk about 5 times leverage. People talk about 10 times leverage. What about 1.15? Is your system good enough that if you barely added any leverage, it's going to go ahead and do something like that? That's a 25% drawdown. That's a 25% drawdown. Look at the additional alpha that it adds. But I don't want to talk about leverage. I want to talk about the markets. We don't need leverage at all, right? What about something crazy? What about 1.5 leverage, right? Is that an acceptable drawdown to most? I know most of you had a much greater drawdown than 30% in the last year. Insanity. What about over the last? That's crazy, Jordan. Nothing special happened since 2021. Nothing special happened in the last 2 years. Yep, I know the price action was quite normal. That's another thing too. When we're looking at, and we've talked about before, as monetary reset is underway, it's not a question. We looked at and recently it's been looked at a lot. Gold priced in the Deutsche Mark, looking at the Weimar Republic, and you could see massive 50, 60% swings happening month over month. If you trade with leverage, you have the opportunity to get wiped out. The name of this game is capital preservation. It's not taking risks in order to get rich, because you're not going to get rich. You're going to get wiped out. It's doing this in a methodical, systematical way, employing an edge that helps you know when to be in the market and when to be out of the market. When to be out of the market is an extremely strong position. We are out of the market today on FOMC day. Do you know what type of a relief that is? Now, if we were holding a position and it was into profit, there's no problems. But coming into the event with this type of clarity and being able to assess the new information that the Fed chair and governors have added to the equation is a significant edge of having to guess which way to go at any point in time. You said 30%. Come on, compounding. Warren Buffett, Renaissance Technologies, right? Those guys compounding the best of the best, compounding something like 50, 60% year over year. To have that type of opportunity for where you are, I mean, you're not Warren Buffett, and you have not had the opportunity that he has had over the last 50 years. When I say opportunity, my uncle, he had 2 newspaper routes, but he invested and held his money in the stock market, and he retired a multimillionaire. You know, we don't have over this decade that same type of, let's say, advantage of that huge deflationary 4 decades that they had. It's a different situation. You need to make sure that you work harder, surround yourself by people and a team who are going to help get you there. A 30% drawdown. You know why? And there were times when a 30% drawdown was acceptable to me. But the truth is, the lower you keep your drawdown, the better. For many reasons, especially as you start growing your money into something that is substantial, and you're not going to grow your money into something substantial if you're taking risks. Now, I know a lot of people who have made when the bull of all bull is running, and not only the reason the bull of all bull is running is why? Is because it's got massive, wins at its back. You have rates down at 0, you have quantitative easing taking place, and you have massive rampant liquidity in the system. When that's happening again, and I believe it will happen again, only I believe the next time it happens, the cycle is going to be even shorter than it was last time. It might even be sharper than it was on the upside, but it's likely going to be sharper, and it's likely going to be more violent. So you just can't get comfortable. But I know a lot of people in those circumstances, I call it the everyone is an expert phase, because it's almost like you could do no wrong. And I know many people who went ahead and turned a little bit of money into a lot of money. I don't know one that kept it. And that's the difference right there. You want to make sure that you're doing something that over time is going to put you in a place that you're able to first generate something substantial, then you're able to produce something that becomes not only wealth. I mean, first you get rich, and then you get wealth, and then becomes generational wealth, because we are looking to take care of those around us and the next generation. You want to persevere first and then thrive. Most people are not going to persevere during this monetary reset. Persevere and thrive. Those are the 2 goals. By taking risks, you are not going to persevere. You're going to be on that universal basic income. You're going to be collecting that stimmy sent automatically from the central bank directly onto your smartphone. But then, man, you better make sure that you don't even take a glass of Coca-Cola or something. If you do, you're going to get dinged. You're going to get dinged quickly. All right, let's go back into it. And bam, capital preservation. Who said that? Capital perverse. There it is right there. That's the name of the game. We're looking at Bitcoin over here, and Bitcoin has once made the breakout above 29,000. 29,000 is a resistance level. When Luna collapsed, here's, by the way, 35,000. If you didn't de-risk at 53,000, now's your chance. A lot of people still didn't buy it at that point in time. And then we had the Luna collapse, and then we bounced. And price found support in this area right over here, 29,000. That resistance held while we were over here in March. It was tested 1, 2, 3, 4 times, and it all held until we recently broke out above. That was a major repair. The structure of the market remains extraordinarily bullish in 2023, ever since we had the bull market breakout. And we called it, and it's on YouTube as it happened. We went from having an extremely bearish bias to flipping and looking and watching for the breakout. Failed. Breakout held. Boom. Not to mention, at that particular point in time, it didn't even matter, because CTM 2.0 got us positioned right over there, below 17,000, right? Taking an emotion out of the game. Now, this may look easy to you, but this was a massive collaborative effort by the team at CTM. It takes massive work to get to this particular place. It's not so easy if you're looking at the fruit of the work. Over here above 29,000, that was an important repair, the fourth one of 2023, and then it failed. And we got neutral. Discretionary trading. Buy, sell. Buy, sell. Buy, sell. Buy, sell, buy. You got to make sure that you have the fortitude to perform on an elite level, especially if you want to be a discretionary trader. And if you want to be a discretionary trader, stop trying to be right all the time. This game is not about being right. This game is about probabilities. It's about when you are right, collecting more than when you're wrong, cutting your losers short, pushing your winners. It's probably one of the first things that you ever heard in the markets, and you didn't pay any attention to it. You heard about money management. You heard about position sizing. You heard about risk management, and you cared about entry, and you cared about what potential was, and you cared about, whatever. Push your winners, cut your losers. Do you think you could do that with a 70% win rate? If you did, you'd be the best trader that ever lived by far, because that's not the inner workings of a successful system in the markets. That's way too high of a win percentage. But most people are aiming for something that they could sit with, something that they could deal with. And that means not even an 80%. They're looking for like a 90% win rate. They don't like to be wrong. They spend all their time putting together their analysis and then placing a bet on what they think is going to happen. That's not how a casino does it. A casino has an edge, and a casino looks to play the most hands in order for that edge to work out over time. Be the casino. You saw the breakdown. We then saw a further breakdown. We looked to go short 27,500 on the breakdown, and then price didn't hold it. It retested, it went for the resumption down, and then closed back above the line. That brought us neutral again. And then price closed back above. You got to get back on the right side. As price closed above, let me go to the daily time frame. As price closed above, I said, listen, that is a bullish repair, reclaiming 29,000 again. And I set everyone up mentally, likely it's not going to hold. And that means, and is going to require you doing what is difficult, and that's getting neutral again. Here we are, neutral again. And you could see that we are underneath 29,000. Price has come in and tested it. You can see the breakdown again. Price came into our magic line, trend line, found support. Price came into, again, that broken magic line, 29,000, important level, and has rejected and is currently neutral. Price right now is very neutral, not just only below 29,000, which it is, right? But I could go ahead at this point in time after having a couple of touches and drawing a trend line. And I want to see price not only get above 29,000, I want to see price break out above this trend line in order to have a buy impulse and then be looking for further upside potential. It's the same way that it's viewed over here as you look at CTM 2.0. I could draw on that same trend line, and I know that we are, or right around it, is when we would be looking to take that long on a closing basis. Now, that's the buy side, that's the long side, and if we're able to do that, we might be targeting the next area of resistance that is coming in somewhere around 35,000. We have light resistance. You see the light line? That's light resistance, and then we got stronger resistance up here around $37,000, $38,000. And a resumption up could be taking us over there. If we see that the Fed pauses and then the markets go on to rally on the Fed pause, we'll look at that in 1 second. Before we do, I just want to show you the downside. This lower green trend line over there, that's coming in today around 27,000. A close below there, that is when we would discretionary be looking to sell, and that would bring up likely a test of this other important repair that took place. This over here I call the Luna low. After price found support and then collapsed, price rallied up in and tested that low. That became resistance. And then you could see again over here that became resistance. If we break down from this area, this likely then is where price will be testing. And if it holds, the structure remains for 2023 quite bullish. It's still quite bullish, but it doesn't mean just because we test it that it will hold. It could break. And if we break it, I will be letting you know what the most important test right over here I'm highlighting and why of the bull market breakout is. Because if that is tested and that doesn't hold, things are going to go very bad very quick. I don't know whether or not the low is in or not. And I could say, well, Jordan, you had like this $1 billion scam collapse, FTX. Do you think that price could potentially go lower? Well, if there's a credit event inside the financial system, yeah, I think that price could potentially go lower. I want to be prepared for it. We're currently in a bull market breakout, but it doesn't mean that it's a given that leads to something like new all-time highs before or after the halving in 2024. It is potentially possible that we move into some type of credit event. If that happens, stocks and or Bitcoin could be making new lows. Now, last time we had a credit event, this is going back into the global lockdowns, March 2020, and everything was correlated down to 1. Equity markets, you could see, and I just want to jump over to them. Let me come on to a log scale with you as we move towards the next portion of this setting. And you could see that equity markets over here, they took out their bear market low. This was the tightening cycle. This where I'm highlighting over here and look below, you can see that red line. That's the Fed funds. You could see in December 2018 was the last hike of the cycle. That potentially is today, the last hike of the cycle. Now, I say potentially because regardless of what happens today, you saw the Bank of Australia move towards a pause, and then they went from their pause back to another surprise rate hike. And the same thing could happen with the Fed going back into the 70s. That happened very often during that inflationary environment. But we can only take it as it comes. Right now, oil is signaling to us that likely inflation after next month's CPI, this coming month, June, what month are we in? This current month's May reading, it might be a little bit high, a little bit stickier. I look back what happened a month ago, and gasoline prices were quite high. Crude oil was trading up. We just saw OPEC cut supply production, and the market's initial reaction saw a spike in crude prices. I think right now crude and energy is looking towards the global slowdown, potential global recession, and they're saying there's going to be much less demand. And of course, we have the U.S. government draining the strategic petroleum reserve as we speak. This time over here is when the Fed hiked rates, and they didn't say we're moving towards a pause, but the market knew that it was a policy mistake, and the market knew it would be the last hike of the season. Legend Paul Tudor Jones that same day on CNBC, and he said that was a policy mistake. It will be the last hike of the tightening cycle, and they were right. This time the markets are pricing in that it is the last hike of the cycle. It's expected. And this time you could see that equities into that last pause were in drawdown, were under pressure. That's not happening this time. This time we saw equities bottom over here, right? You see equities bottomed. What happened over here? Two things. The Fed began a lesser degree of rate hikes. So you can see that equity markets, instead of bottoming on the last hike, as they did over here, they bottomed on the lesser degree of rate hikes, as well as inflation started rolling over at this particular point in time. And that's where equities, so something's different. It's not the same. And the reason I say that is because a lot of people are expecting on the pause today some type of melt up in equities. You could see that equities went on to make new all-time highs after the pause. By the way, this was still during the tightening cycle. Quantitative tightening was still going. Quantitative tightening continued at this point until September 2019. Equities made a new all-time high under quantitative tightening, and then something happened here, and equities melted up. Why did they melt up? Because something broke in the system, the overnight repo market rate, and balance sheet expansion continued. As we continued in these unprecedented times, above all, watch the balance sheet. If balance sheet expansion is underway, my belief is regardless if quantitative tightening is running, if rates are being raised, because in 2024, I don't know what's going on with inflation. Looks like the Treasury is getting ready for some type of yield control curve. How do they get the money? Oh, wait a second. How do they get the money for this? Oh, wait. The Treasury could get money either from tax receipts. Tax receipts are going down. We just even saw that this year, the tax receipts were substantially less than expected, which is why they expect to run out of money by June. Well, the U.S. could be running a trade surplus. No, definitely not running a surplus. That was going on in 2000, by the way. And what's happening now, though? Well, they could go ahead and they could have the Fed go ahead and do new issuances and go ahead and sell bonds and raise money that way. Oh, so there's going to be balance sheet expansion. Why rates are being capped from the demand. That's yield control curve right there. And if that's happening, equities should love it. Bitcoin should really love it. And I expect that they rip. Let me come back over here. We were talking about during the credit event, equities came down and took out that low. NASDAQ did not take out the low. Here's the low in the NASDAQ. And you can see during the crash, they did not. Bitcoin kind of traded at the same level, right? Here's the low and here's the collapse of Bitcoin. What's the price over here? Bitcoin went down lower than 3,800, right? Let me check Bitstamp. That's just Coinbase. It's showing the same thing, 38,000. Bitstamp, 3,800. I still feel like it went lower. What did BitMEX do? Who knows the ticker for Bitcoin on BitMEX for Bitcoin? Does anyone know the ticker for Bitcoin on BitMEX? I'm going to find it because I want to know what it was. It was the largest exchange at the time. I'm looking. If someone could help me out, I could use the assist. I'll come back to it when you all let me know. It starts with an X. I can't find it here though. I just wanted to see what the low was because I thought it was like 3,500 to be honest. Anyway. Oh, you guys up here? Yamoto, there's a fine line between love. We have lots of love for you. We want to help you. We want to take you with us. There's also a fine line between a call for attention and between spamming and or you know your job also should be to want the best for everyone around you. Like that needs to be your demeanor, right? You want to have the best for, so you have to wonder if you're FOMOing, if you're exhibiting traits that are not conducive to successful practices for trading in the markets, whether or not you are thinking enough of those around you, right? Is very important. A team works together in every which way. So you got to go ahead and do that. 50 basis points is not on the table today. It would absolutely crush and break the banking system. XBT, let me just go ahead just so I know for my own knowledge what happened over there. Thank you all for bringing that up. Oh, XBT. We got perpetuals now. I guess we'll look at treasuries. At Tether, at treasuries. What's going on with me? I don't know why I'm having such trouble. But really what I'm doing is just buying a minute here to take a bit of time. I don't know. I can't pull it up. Well, and Vacanet, do you remember back during March of 2020, the end of March, when the Fed came to the rescue, did their balance sheet expansion, and everyone was talking about like insolvency event ahead, markets taking out their lows, 1929 chart fractals. And we were like, no, listen, there was a crisis and the Fed responded in such a way that there's not going to be another crisis for some time. And likely that crisis will be around the time they're ready to introduce the central bank digital currency. Now, I do not think that even though we see beta launches of Fed now, that the US is ready to introduce the digital dollar. They could be. It looks like Europe is going to come first. It looks like the stage is set and we will see a digital euro before a digital dollar. And you have to wonder what it's going to be. I don't know whether or not we are going to see a deflationary credit event happen, let's say this year in 2023 or even longer than expected, maybe into 2024. It's possible that that could happen. And I don't think the Fed wants that to happen. If that does happen and the Fed is forced to go ahead and then have another major expansion of the balance sheet, that is going to cause sharper and quicker cycles and is going to cause inflation, which is out of hand, to become grossly out of hand. Double-digit inflationary CPI numbers, and we all know inflation is higher than the readings that they tell us. So I don't think they want that to happen, but the thing is, as they're trying to walk this tightrope, the odds or the risk of that happening are substantial. Probably what they would like to happen is for indeed there to be like some type of severe slowdown or even any like a small recession, and something that they're able to kind of just manipulate through lowering rates down, easing the market, and then going ahead and being able to go ahead and begin raising them again and when needed. I mean, that would be like Powell falling from an airplane without a parachute, pulling an arrow out of his quiver, and then shooting it back into the plane that he's dropping from. I don't think that's going to happen. But it is possible. It is possible that they do what they're best at, and that is prolonging the inevitable. And they are masters at the way they manipulate. But we want to be ready if there is a credit event for what could happen. Now, I know that from a CTM 2.0 standpoint, it doesn't matter. We will be on the right side. If the markets are crashing, we will simply be attacking from the downside. It's just how the system is designed. It's a momentum-based system. It's going to keep us on the right side. Now, even if someone's trading on the daily time frame. By the way, the daily is hedged going into this event. Bitcoin is out of the market. It is completely neutral. Ethereum is holding a short position and Cardano is holding a long position. So do you see the hedge? Short the market, long the market, out of the market. Regardless of the outcome, it's just a hedge. And that's a good place to be as well. I prefer this one being neutral, but either which way, it's still a good place to be. There's a lot more I want to talk about, so I want to keep going. All right. So let me come back and I'll finish whatever thoughts that I was developing over here. So we saw our S&P made new lows from the time that the Fed began pausing, right? Here's where equities bottom. Fed began the pause. You can see the rate hikes paused over here. By the way, you often hear that as soon as they pivot to rate cuts, you're going to see a crash in the markets. Well, here in 2019, you saw the Fed cut rates, not once, not twice, 3 times, 75 basis points, and equities were making new all-time highs. People, again, all I'm trying to point out over here is that, well, this time here was different. This time here is different. And even though it's good to be aware of what potentially might happen, above all, follow price. I talk about potentially here that if we enter the pause today, that we could see equity markets begin their melt up, right? Now, it's a little sensational. It's a little not. This is where the pause happened last time. And equities indeed did melt up, make new all-time highs. And then balance sheet expansion started and they melted up until the planet Earth went to global lockdowns and we had a credit event. Now, likely if there wasn't global lockdowns, there would not have been a credit event over here, and likely this type of trajectory would have continued. Okay, we could enter a place like that where we just see further debasement. Let's get it over 100. If you like being here, I like you here. I like being together. I like the vibe that we set over here, and we keep going. All right, so I got to make a couple of more points over here. I think that's going to make Bitcoin shine. Bitcoin will have its grand awaken. We talked about how the Treasury is going to raise funds for that. We talked about the relationship, and we have talked about the relationship a lot between yields and Bitcoin in this high inflationary environment. If yields are capped, Bitcoin has the opportunity to explode to the upside. Yesterday, we were looking at liquidity rising as Bitcoin was rising. We talked about likely the reason Bitcoin is rising here is because of the liquidity. I didn't know where that's coming from, right? And you can see over here, Justin's rendition, you can see the liquidity rising and Bitcoin was rising with it. And I didn't know where it was coming from. I said, maybe it's coming from the reverse repo market. We can't find out till tomorrow. That's not where it was coming from. The next thing that we see that the US Treasury yesterday, which is where this was coming from, they had $78 billion one day injection. They are running out of money and quickly. And this was where it came from. So when we talk about the coming liquidity crunch, the double whammy tightening, the US Treasury right now is counteracting quantitative tightening this whole period here. Soon, they're going to be going the opposite way. They're going to need to be raising new money. People wonder how they could get the money to do this. They're not going to, in 2024, when this program is expected to begin, they're not going to start at that particular point in time trying to raise the money. It's between the summer when the debt ceiling is settled until 2024 when they're going to be raising the money. And that, again, is you're going to see the cash balance much higher by the end of 2023. And that is going to cause, in my particular opinion, further stress on a very fragile market. Now, it is possible Powell comes in today and he says, do not worry, my friends. The system is so bad and so fragile that we are going to stop the quantitative tightening program. I don't think that's going to happen. If that did, that would be a game changer. A couple of other things I wanted to look at because I said we need to make sure that we're on the right side. This is looking at I want to be on log scale. Here we are on log scale. Let me get rid of the balance sheet. Let me pull up some sketches for you, and let me just show you where we left off the NASDAQ. By the way, we've had the bear market trend line over here. This was a breakout. This was the first major repair that took place. This purple line was the second. The structure over here is bullish, but we are in a downtrend, and this is nothing more than what looks like, and you can see it very clearly over here. If I draw in, all right, I'm going too fast. This line over here is the most important line on this chart. If this breaks down, this move is then over. That's a sell impulse. We have to watch out for that. This yellow line, which we used last week, I could get rid of right now. That's just noise. You could see this top green line over here, the bull flag that price was consolidating in ultimately. You can see price broke above it, got back below it, and is testing that resistance right now prior to the FOMC as we speak, and that is providing resistance right now as we speak. A breakout above this today and a close above it, that is likely taking us into this area over here, that green line. That is the August high over here. That is where price found support, resistance, support, and then major resistance right around this area. It doesn't mean it can't break above it and or continue, but this is the next target if we close today outside of this bull flag. If we close in it, we're neutral. If we break down from this line, watch out. That's a sell impulse. I want you to see what that sell impulse looks like. First, I'm drawing in that area of support. You could see, by the way, one where we peaked in the other day, and that area over here was also support right here, and it was also resistance, and it was support right over there. It's a box because you could see the top side of that resistance as well. The top side of that resistance should now be support. And there's also one in between, right? And I could just draw it like that with my mouse over there. So it's this whole area, right? Price needs to break below that to see some type of sell impulse. I have that right here, a close below 27,750. Where's that sell impulse line over here? 12,750. That's down over here. I'm just trying to get that best awareness that I could get. This over here gives you, I'm going to draw that line in, that important line we're watching out for. And then I'm going to highlight the top end of that resistance. And then you can see very clearly what we're looking at is a bearish continuation pattern. I talked about the bullishness of the two breakouts, but this is still a downtrend. And that looks nothing more like a rising wedge in a downtrend, which is a bearish continuation pattern if, only if it breaks down. This could also continue to hold as support, as it's held as support. And not only that, this could break out to the upside. If this were to break out that resistance that we showed over here, this upside resistance to the upside, that likely then becomes a near-term top as that leads to some type of exhaustion. We'll look at that if something like that is happening. That's where we're at today. Ahead, I wanted to make sure you had the levels on the NASDAQ. I wanted to make sure that you had the levels on Bitcoin. And I wanted to make sure going into the event, you were worried about all possibilities. Thanks, JC. All right, everyone. That's it going into the big event. If you are new here and you're not yet subscribed to the channel, go ahead and join us. Join CTM, the best I know of. We work together. We work hard to do our best to stay on the right side. We want to take you with us. We want to take everyone with us. Everyone, Powell takes the mic at 2:30. Rate decision is at 2 o'clock p.m. Eastern time. Jose, everyone, thanks for being here. What do we got here? Yeah. All right, everyone. I'll see you later.